All right. Well, thank you for attending today. My name is Jake Johnson with Johnson Consulting, and today's webinar is about how we grow in funeral service. And I hope you'll find this information helpful. And I am a little bit new with webinars, but at the same time, if you've got questions, I think I might have those available as a Q&A in this webinar session. And if not, I can be reached after the webinar at my email address at jjohnson@johnsonconsulting.com or at my direct line 480-556-8502. Today's webinar again is on acquiring existing funeral business and what do you need to know. And this is something that I've had a lot of experience in through my father initially, and then in my own dealings with acquiring funeral businesses when I got out of college, and then up to today with my own funeral home and a consulting business that helps others do the same thing. So I want to give everybody just a little background on what we do here on the consulting side of my life, and then get right into the acquisition techniques and strategies and things that you can use on your own as well. So Johnson Consulting is my consulting company. We're located here in Scottsdale, Arizona. We do mergers and acquisitions, which we'll be talking about today, business appraisals, valuations, loan sourcing, management, financial accounting, bookkeeping, management consulting, strategic plans, incentive plans, things of that nature, staff training, survey sales analysis, life insurance online training, and then a wealth management, personal and business wealth management division, as well as a case management software for funeral homes across the U.S. And all that being said, the fact of the matter is, if you look across all segments and professions, successful operators grow. We like to think, and we feel strongly that those of us within Selected are successful and highly functioning funeral businesses, and we grow. But there's different ways to grow, and that's the purpose of the webinar today that I want to share with you guys. The one thing that I learned a while ago listening to presentations is the word scale. And that is just how we grow. How can we grow as funeral operators? And that can be a difficult challenge in our markets that we're captive to, and the possibility for acquisition of other businesses and other customers. And so we know that. And so, you can either grow organically, by customer acquisition through marketing, and which can be slow growth, or you can acquire, which is certainly faster, but there's more risk to it. And I'm going to go through both of those today on this presentation. So first thing is that, do problems exist out there? Absolutely. As it relates to this, we know problems with case count, mix issues is a big thing, revenues, market share we're staring at, personnel. I always like this slide because of the faces. You see that within your own probably place those faces within your own organization. Cremation rate trends that look like this, free cash flow that may look like this, and a host of other things. More training needed, blending tightening, increased regulation, insurance costs, changing consumer preferences, changing labor pool. And so I always like this quote because it's just the truth. I mean, you just got to get busy living or get busy dying, and we got to pick our side and make a run at it. And no doubt that's why the group is on this phone call today, to understand that and see, and has done. No doubt there's some of you on the phone, or many of you that have already done this, and I applaud you. It's there's a lot that goes into it, and mistakes can happen, but that's how you learn. But it's the way to tackle these challenges that we're faced with in our profession. So the question is, how can I grow outside of my own facility? And the two answers I'd provide are: start a new funeral home location or buy an existing funeral business. All right. And so what I'd like to talk about first is starting a new location. For those that have done this, just a few tidbits that I've learned. guidance that I've learned from others that have done this on their own. And the first is that if you're considering this, get a market study done. As I would always say, it's the best money you spend before you spend money. And this is to find out, the market and consumer preferences and what the market's desiring, the potential funeral customers in your market. There are companies that do this. I'd highly suggest a market study before starting a new location. And then the second thing, which is a little rule of thumb that I use just to weigh into the decisions that go along with starting a new location, is considering the investment or business value and then backing into the development cost of that business. And what this means is, if you imagine for a moment, you want to enter into a new market, and let's say that you are thinking that this funeral home can do 300 calls. So take that 300, and if you had a piece of paper and you're writing this down or whatever your number is, and now multiply that times your average sale. Let's say your average sale is 5,000. I'm going to use that for an instance. I wish mine was 5,000. It's not, but let's say 5,000. So that's $1.5 million. So, and kind of keep that revenue in mind for a moment. Now let's go back and let's decide just how much it's going to cost to build this funeral home. Let's say it's going to cost you $2 million. I'm going to use $2 million. Use $2 million, and then you would take if you were to consider that a business that you were selling, you're going to divide that by a market multiple. Then I'll get into market multiples in this presentation, but let's use 6 times. You know, you hear EBITDA multiples and things like that. So we're going to take 6. So we're going to take a $2 million value, and we're going to divide that by 6. We're going to come up with what would now be an implied cash flow of $330,000 that this business is creating. All right, and we're just going to continue to work backwards here. If we can assume that $300,000 is the cash flow, and let's assume, and I'm going to show you benchmarks in this presentation also, that that represents 25% of your sales. If you were to say that, what you come up with is sales of $1.2 million. And so as you continue to keep working backwards, now let's take that $5,000 average sale that I had, and now we're saying that this firm needs to produce 240 calls at some point, purely from an investment standpoint. And that's only one way to look at it, but I offer that little rule of thumb and formula just so some of the businesses that I've been involved with in helping people sell under unfortunate circumstances is when they built that second location and they overbuilt. And so these are just some rules of thumbs as you get into considering starting a new location. So now let's get into buying an existing business. I think that's why we're here. And I've got lots of good notes for you to take home today. So let's first talk about the process in general. So in general, you imagine this type of process in acquiring another business, funeral business. You're going to have discussions. You're going to sit down and determine what success looks like to the seller. Discussions could be a year's worth of morning coffees quarterly, and just establishing a relationship with your competition, which can be difficult in some markets. And it's never early enough, and it can be too late. And it's something you just want to have the doors open. You can respect each other for competition and things you're not going to share, but having that channel open, if that day comes, is invaluable, and it doesn't happen overnight. Sometimes you can get lucky and it does, but it doesn't happen overnight. So starting those discussions now are very important. And at some point, you're going to want to, once somebody's amenable to having that discussion, the first question, and I love to ask this question because you can use it with your staff, you can use it on yourself, and that is, what does success look like to me? In this case, what does success look like to the seller? What are their hopes and dreams? What are they trying to accomplish? Because that would define a successful transaction. And while money is important, unraveling what the other points of success look like for the seller are very important in a successful negotiation. So you have that. A letter of confidentiality is always a great olive branch, as they say, to let them know that you know this is confidential and that you're going to keep it that way, and you only use this for the purposes of reviewing your data. in which case then you get into the financial review. And once you get in that financial review and you have a semblance of what you think the cash flow is, and you get into structure, what the value is, and that scenario I just used, if the price is $2 million, how much of that's going to be in a covenant not to compete, and how much is in a consulting agreement, what have you, and you're really going to put some thought into that structure because it's very important. That will get translated into the letter of intent. You hope that that gets signed, but there's usually a little back and forth with the attorneys. Due diligence, if it does get signed, due diligence starts. With also what would be called the more formal document process, where you have the asset purchase agreement or stock purchase agreement and documents of that nature with the attorneys, and you hope you head towards a close. And how much time does this take? 5 to 6 months. It could take longer. We've seen transactions shorter, but I think you can expect that it's from beginning to end 5-6 month process, given banks and all the other parties that need to be involved. So just a little background on just the general process. So let's talk about determining value. This is always the fun part. People always perk up with this kind of stuff. So multiples. So you hear about multiples with values of funeral businesses. You hear revenue multiples, you hear per call, you hear EBITDA multiples. I can tell you this, all the funeral businesses I've looked at, the ultimate multiple that I want to look at is the EBITDA multiple, and I'll explain what EBITDA is. But EBITDA is the net income, and then you're adding back your interest expense associated with your debt, your income taxes associated with being the owner and personally and business-wise, the depreciation, which is a non-tax expense, and your amortization associated with non-tangible expense deductions for tax purposes. And so they call that EBITDA. And what it reflects and why it's important is because that's the cash you assume to have to pay for new debt on the business. And so it's a very important number to arrive to, and that's why the multiples based on that are the most applicable in successfully valuing a business. Now, I will use revenue multiples at times as a measure when EBITDA can get to a high side in an organization, and it helps me just keep values in check, but that's for another presentation. So anyway, EBITDA multiples is what I'll be using and talking about and how we get to those today. So, when you're determining the value, let's talk about that. Ironically, you think there's just one value. The real point of it is what is the purpose of what's going on here? Are we selling to an employee or a family member? We often use 2 columns to determine what that EBITDA or cash flow may be to provide perspective to the father on, and for both parties, if it's a father-son, on just what that business value may be worth in the open market, but also create a column for the son, if I would use that son or daughter that would run the business, and some of the additional expenses they're going to have. And we try to meld those ideas together so that we have a fair value. And so that's one way to look at a value. Certainly selling to business to an outside party is another. If you're buying a business, you're hopefully, you should, every party in a business acquisition should feel like they gave up something. And so when you're buying a business, maybe you're paying a little more, but you're hoping to pay your initial presentation as minimal as you can without insulting, of course. Are you liquidating the business and the real estate separately? That's going to be a different way to look at this business value. That's very specific to very specific circumstances. That's only available if there's other businesses in the market to absorb that business. And then you can hear about minority interest or market, the marketability and control of, let's say you have 10% ownership in a business and there's really not much you can do without the other 90%. There can be an implied discount associated with that interest, and there are ways to look at it with that. So just one thing to consider. So I did get one question that says, if the LOI specifies a time frame for due diligence, but the seller is not forthcoming with documents, can the buyer delay the closing? So one question I just had, if the LOI specifies a time frame for the due diligence, but the seller is not forthcoming with the documents, can the buyer delay the closing? So in the letter of intent, there's going to be a termination date on that letter of intent. And the bigger question is, if during due diligence the seller is not forthcoming with documents, you may have a bigger issue that needs to be addressed. But typically, certainly in the spirit of the transaction, if the buyer is doing what they need to do to get this done, and the seller has, maybe there's some good reasons, maybe there's been some family issues or an illness, and the seller has just not been able to get the information to the buyer, my advice would be, first of all, in a letter of intent, you want to specify a drop dead date in which the LOI dies and the transaction does if things don't proceed. However, in this case, because that type of statement protects the seller so that it does not drag on in case the buyer is slow. In the case of this question, if the seller is delaying, if the seller does want to proceed forward, but you have one of those clauses in the letter of intent, which you should, you would want to send a letter to make sure that the LOI was extended and it was agreed upon, and hopefully that it flushes out any other reasons that might be out there for why the seller might not be providing the information. So I just want to address that one question real quick. So can there be different values? Yes. And so the big part about acquiring businesses, and it doesn't matter if they're funeral homes or anything else, is you need to figure out a budget, or in this case, a pro forma or a projection of what you think this business can do under your ownership. So conducting the financial review. And I think this will be helpful to this group because it's not only helpful in acquisitions, but I'm going to provide you benchmarks that you can consider on your own financial statements as far as where you're at and where you could be, or where a buyer might be acceptable, where you would be in your different expense categories as a percentage of net sales. So let me go through this. So forecasting revenues. That's the first and most important thing of a financial review, and there's some exact methodologies that really help you narrow down exactly what they are, to make sure that, because it's such an important part of the analysis, to make sure that you've got the correct revenues. Certainly gathering a tax return to reference that to the financial statements would be key. Conducting a sales contract analysis is invaluable. That can be difficult to do, and I would almost advise not to do in an initial review, just so that you can keep the discussions going. I think the more data you're going to ask for in an acquisition, the more opportunities you're giving the seller to just be too overwhelmed and say, I don't want to do this. And so at some point, though, a sales contract analysis, I've done a ton of them, and that it can be done where you flip in each contract, you're looking at service fees, caskets, vaults for each case type, and looking at the mix. It's a great way to look at funeral home revenue mix. So it helps you break out the mix. You're getting the calls per case type, the average sale per case type, the average sale per sales items, and inevitably what you really want to see is net revenues. You do not want the cash advances in this projection, otherwise the benchmark numbers I'm about to give you will not make sense. So net revenues, those are the revenues you're keeping before the accommodation income that's going out to clergy and what have you. So the purpose is to identify exactly how pricing strategies will impact your sales. So because obviously there's going to be a different culture and pricing going on at this organization you're buying, and you need to have a good understanding of that. So second in this financial review is your cost of goods, and I'm going right down a financial statement here. So how I look at this is these are costs for caskets, vaults, urns, markers, rebates for purchases. Tax accountants will put labor sometimes in cost of goods. I don't like it there because labor is a very important number. I like to see that separate. So the benchmark in the section using these expenses to net sales usually is in the range of 13 to 19%, depending on how many markers and vaults you're selling, and can be lower as well, depending on how high your cremation rate is. So first section and benchmark to this. Second one, or the third, is payroll in your financial statement. This is officers, full and part-time staff, benefits, contract labor, training expense, uniforms, anything associated with having an employee. The benchmark in this, when you adjust the owners, I'll explain that in a second, is usually 25 to 35% of net sales. And what that means is that if the owner is in there, and let's say the owner is making, it doesn't matter what the owner is making, let's say it's $200,000, and a direct replacement of that owner to manage that business, it will never be managed like the owner can manage it, especially out in the community. But if you had to find somebody to replace you, that you went out on an island, how much would that payroll be? And so you remove the owner, you layer back in that payroll for the replacement, And typically you will end up at about 25 to 35% of net sales when you're looking at your own business and the business of others. So these benchmarks should be helpful. So just staring at that screen for a second. The next one is facility. Anything associated with facility, building insurance, liability, telephone, utilities, repairs and maintenance, rental expense. This benchmark has two components because some of us lease back to ourselves or we lease from other people. So if there's no rent, the facility section of this P&L is usually 5 to 10% of net sales. And rent benchmarks in the funeral space that I've been involved with, most are triple net. That means the funeral business is paying for all of the expenses of operating in that real estate, and the landlord's just collecting rent. They're not paying for anything. And that's usually 7 to 12% of net sales. So I pause there and say that, but these are the typical benchmarks we see out of all the clients we have, as well as my own businesses, and when we help people buy and sell businesses. In vehicles, anything associated with vehicles, the benchmark section of this is usually 2 to 5%. Advertising, donate anything associated with marketing of the business, 2 to 6% of net sales. And then the remaining are what I would call other general administrative, bank fees, bad debts, licenses and permits, office supplies, office expense, equipment leases, etc. And when we look at businesses, this is an important one. It depends on where in the U.S. You are, but bad debts expense can be something we see that can creep up to 1-2% of net sales. And when we analyze a firm with the appropriate, you have to assume, if you consider even your own bad debt expense, we typically assume that bad debt expense can be managed at 0.5% of net sales as a benchmark, and sometimes less. But I wanted to throw that out there. But then this entire section is usually 4 to 6% of net sales. And what is the result of all this? It's that cash flow number we're looking for, this EBITDA number, they say, this earning before interest, tax, depreciation, amortization. And why EBITDA? Because that's the cash available before debt payments. You're about to buy a business. You're trying to figure out what your debt, what cash you have available to make debt payments. You have to go through that exercise that I just mentioned. And so you'll hear banks talk about debt service coverage ratio, the DSCR point that I have here, or the fixed charge coverage. And I bring up that note because this is an important part of acquisitions as well. And that is that when you're buying a business, you've got the cash flow that you determine. And let's say that your cash flow is, actually, I'll approach this example better. So let's say your debt that you want to bring on is going to cost you $100,000 a year in principal and interest. So the debt service coverage ratio would say that if you have $100,000 a year in debt payments, most you'll hear them say, I want a 1.4 fixed charge or 1.4 debt service coverage ratio. I want 140%. Is another way they'll say it. What they're saying is that if there's $100,000 in principal and interest, they want to know that you've got $140,000 in EBITDA or cash available to pay for that, or $40,000 in spread. Now, the example I use of $100,000 or $140,000 in EBITDA, this is, if you're hearing what I've mentioned, you're talking about $40,000 left over for the whole year. And we know, depending on average sales, that can be pretty tight. So I would always caution you that you will find banks that will be comfortable at a fixed charge coverage on this cash flow, but it doesn't mean it's the best news for you. Even though the bank's willing to give you a loan, you may not want that loan because you might not have enough coverage personally with the way you operate that business. I think another interesting facet is when I talk to owners and they're struggling with the cash flow available, and I'll look at their own businesses and determine that their fixed charge is 2 times. So basically, in my example, for $100,000 principal and interest, they've got $200,000 in cash flow, and I look at them and wonder why they're feeling like they don't have enough cash, and sometimes it's a personal exploration into your own spending habits. So I like this exercise for determining your own spending habits within your own organization, but these are the things you're going to have to consider when you're buying another funeral business. So capital expenditures, don't forget those. Those things are not on that P&L at times. And there's things you have to consider. You know, you're going to have to buy new cars. Is there a new roof that has to go on before you even buy this business? How about new carpet? You know, how are you going to create that saving plan now by borrowing money or in the future? So don't forget those. So now that you've done that financial review, you know, and I've got some examples I want to show you, but oftentimes people might stop there, and maybe it's because they know their market and the outlying conditions beyond financial, but I want to go through those outlying conditions. We call them our value matrix, but they're very important. And every valuation that I look at in funeral homes, we run through this exercise because it helps us narrow in on the overall value of the business beyond what the cash is, because we know that there's plenty of other outside factors or forces that are impacting this business. So here is our list. So we want to know where the property location is. Is it in the path of progress? What's it going to look like 5 to 10 years from now where that property location is? How about the functionality of the facilities? Is it able to handle the volume of business that it has, or is it an inefficient workflow in that building? How about the case count trend? Is it got a good trend heading up? Is it stable? Is it heading down? Mix issues, we know we'll see some of those. If you want to call them issues, I call them opportunities, but we need to, you know, there can be some instances where the revenue is stable, that you're seeing some mix issues that might be a concern in an acquisition. You know, how is the market share trend of the firm? How's the demographics trend around the firm? Is it a full service business versus low cost? These have different values. How about the personnel mix? Is your personnel mix in the business you're buying, or even your own business, an asset or a liability in the future? You know, and that's something that needs to be addressed that can affect value. And what is, in general, what's the life expectancy of the business that we're looking at? But it's a singular question to ask as well. Client specificity, I put that out there. Is it a business that's a Jewish-only business, or white, or African American, or, you know, is there a specific clientele, and how does that affect the value of the business? Because it can. You know, are there multiple locations that you're of this business you're buying, and are they getting economies of scale, or what I would call scaled down economies? And call volume size of market. Is it a combo? Are there covenants in place with the former ownership of the business owner you're trying to buy this from that might be of issue or concern to you? You know, is it the franchise name in the market? Is there new competition? Are there living quarters in small towns? This is important. You know, the list goes on, and we do go through each one of these from determining just kind of a checklist of how great the business is situated for an acquisition. You know, are there employment agreements in place? Are there options to buy the business from an unknown person that you're just really setting a value for that person? You know, is there first right of refusal, or are you going to get one? You know, how's their OSHA compliant at the crematory age? You know, are the capital improvements necessary or needed? Environmental issues, ADA, liabilities, lawsuits outstanding. These are all things that would be in a due diligence question that really do impact value, and you want to know the answers. So I believe I've got this recorded, and I'm happy to answer questions as it relates to that list. But that's an important list to go through and something to review. So I often get this question: how does pre-need affect the value of your business? And it affects it in a couple of ways. When we look at business, funeral businesses, we'd like to see, does the funeral business have a healthy book of pre-need business sales for the future? You know, what's their revenues look like, and what's the pre-need book of business waiting to be serviced? And I get this question a lot because there's a lot of issues that come with having written pre-needs, or maybe you had a pre-need company went out of business, and now you got all these discounts. And I would share this with you: if the pre-need book of business that comes in will be in that sales analysis that I described earlier on. So you're really giving value for that pre-need business as it comes through in the business and is serviced at need. And usually for most of you, that's going to be anywhere from 20 to 40% of your at need business, probably 30%, 25 to 30% of your at need business. So you really are paying for that pre-need book of business as it comes through. The next question is, you know, is that that book of business, regardless of the discounts. If you're already receiving those discounts in your sales, then you're already accounting for it in your value, just as a note. However, if there's been some recent changes or something happened to maybe some of the like an insurance company, you hope this doesn't happen, but it has happened in our profession, and it's a recent phenomenon. And the business you're trying to buy was, let's say, in the NPS fiasco happened last month, and now you're trying to buy a business, and the business has a bunch of NPS contracts. Well, that's going to be something you're going to have to dig deeper on. And it starts with understanding what are the pre-need fulfillments, how many were NPS, what are the new discounts going to look like, and applying those discounts to your financial forecast. We've done that before. But anyway, that is how you, the high level of how you address the pre-need funds. But they are valuable. When we look at business and see a good volume of pre-need business there, we see a lot of customers that are going to be going to that business into the future. And what's interesting is they keep coming back. We've sold some small SCI businesses in the past that most of their business was pre-need fulfillments, and the business was declining. There wasn't good service going on, but those families were still going back. So it does lock in those families, and I've seen it happen. So that's the comment on that. So let's say you bought it, now what? So here's just some comments that I would make. There's a lot of uncertainty in the beginning, so you need to reassure the staff. Everybody thinks they're going to lose their job. If you've been through this before, you know what I'm talking about. Be open to their processes initially, and there's some things that might need to change immediately, but you want to implement a process and sequence or create a strategic plan with the group to really, dig into what is going to be a different culture than what your business is. You might have to get rid of your ego a little and listen. I always say this, he's an idiot, but he's our idiot. We've had businesses that you just can't believe, and I'm sure some of you have seen this, where you can't believe customers go to the business for whatever reason, because the person was unethical, what have you, but they still go there, and you still kind of got to massage that relationship until you get yourself in the door, because they can really poison things for you. So remember that you're dealing with melding cultures, and how well do you work in the gray area, because you might need to. So how about buying businesses under a succession plan? I've been involved in this personally with my father, and we help other businesses with this. And the question is, how well are you preparing family and key employees for the future for this transition? Always remembering that great funeral directors sometimes don't make great arrangers, or great arrangers don't make great managers, or great managers don't make great owners. Not all can go to the next level, and that's okay. But you got to identify that before you set them up for failure, so that training and coaching is important. Are you addressing the issues of capabilities? Are you working yourself out of job? Are you following a strategic plan? Job redundancy. These are things that you're going to have to consider when you're buying a business, and how well that was done as well, and just where you're going to have to step in and take over in this process. Was the owner you're buying keeping all the secrets, community to themselves? How are you going to maintain those relationships? What type of commitment has the key person or family members made? Employment agreements. I've talked about this a little, and I always love saying, don't be in denial. Denial, as one person told me, is not a river in Egypt. So make sure that if you're the father and you're the son, and you want to acquire the business from the father, be thinking now how you're going to pay for the business. Don't think it will just happen. You want to be working on this stuff. And then the valuation for both of you to consider. Should you expect a value a large buyer would pay, or should key staff or the son or daughter expect a huge discount? And the answer is yes and no for both. So just a comment for internal acquisitions. So just a reality that I learned, especially with internal acquisitions. Remember that your father or mother are used to the cash flow and feel they're going to live forever. And I know some people are smiling when I say that right now. And the son and daughter are trying to conquer the free world. I live this myself. And starting now, because it takes time to kind of meld those two thought processes together. So let's talk about impacts on value and risk and reward. And this is, the risk of buying a business or the reward of buying a business, and the risk and reward within your own businesses. So calls and their impact on value. So somebody says they want to sell their business, they call you and say, I'm a 500 call firm, what's my value? That's a dangerous comment to respond to, and I'm going to explain in this scenario why. All three of these businesses are 500 call funeral homes. And so when you stare at them, the question would be, which one's the most valuable business of all these? When I look at business 3, it may be the most valuable one in the future, but it's hard to know whether that's a 500 call firm now. Business 2 certainly looks like it's losing calls, and so it's business 1 with the stability that's in there that, as it stands today, if I were looking at businesses, that I would say is it has the most value because I feel comfortable saying that it's a 500 call firm. So these are some of the dangers and alerts and warnings, the things that you need to consider when people are trying to have you just come up with value based on their volume if you don't know their trends. So let's talk about this scenario. I lay this all out there. Let's talk about a business that has average call of 4,500, and it's a 500 call firm, so their revenues are $2,250,000. You've got a cost of goods at 22%. Let's use an EBITDA of 30% and a 6-time multiple. So let's say we got a business that's worth $4 million here, 500 call firm worth $4 million. So what happens if you're able to, let's say you bought the firm and you're able to add 10 more calls, or let's say it's your firm and you're going to add 10 more calls by buying a firm or growing organically. 10 more calls at 4,500, the revenue is 45,000, the profit is 78%. Assuming that you're not going to need to hire staff or do anything else, and you can maintain those fixed expenses within your organization, and your organization is worth 6 times, if you add 10 more calls within your firm at $4,500, you've just added $200,000 in value. People don't look at it this way, and it's real. And so feel free to stare at this and ponder it, but it's a real thing. And if you can assume these are 10 more calls, you've added that much more in value. So the question is just how much is it worth to you to get those calls, either through marketing or buying the other business. But no presentation would be good without showing you what happens if you lose 10 calls. So let's talk about losing 10 calls. So we know that's $210,000 the other way. What happens if you lost 20 calls? Let's say you lost 30 calls, or you gained 20, or you gained 30. These are the numbers. And so it shows the value of acquisition, but it shows the risk of losing calls and why we need to grow and at least maintain what we have, for sure, within a business that can be slow to grow or maintain. So I'd love to even stop there because I know it's a lot to think about, but I want to talk about average sale impact as well. Let's talk about you buying a firm and you're able to add $100 more on that 500 call firm, or you apply this to your own firm. And so the revenue growth is 50,000. The profit, well, nothing else is going to cost you anything for that. So when you're adding 50,000 and you're using that same multiple, you've just added 300,000 in value. And it's real. We don't look at things this way because we shouldn't. We have a day job, but at the same time, when you pause and look at this, it just shows you why all of you are on the phone today. How can I acquire those calls, either through growth or buying businesses in town or starting a funeral home? There's a lot of opportunity out there. And so these are slides that really kind of send the message home. Problem is, I have to go the other way. What happens if you lose $100 in average sale? How about you lose $150? How about you lose $200 in average sale? These are real things that happen within the organization. And so when you're buying, and you have to think about that when you're buying a firm as well. And, if you're buying a firm and you've done the contract analysis and the average sale is higher than yours, and you're going to bring your price list in and your sales principles with your arrangers, that might be a real risk to the value you just paid for that new business, or vice versa. So there's opportunities and risks associated with that depending on which direction it's going. So the other thing is just the arranger impact when you buy the business, and the training and the opportunities that reside within your own and businesses you acquire with the arrangers. And we know there's arranger training out there, or monitoring sales average and customer metrics. But if you look at this scenario for a second, you have 2 arrangers, and these are very likely scenarios in funeral homes where you have one that's an average sale of 4,800 and another that's an average sale of 4,200. And let's say they're both handling the same number of calls. And when you look at the revenues, you look at that EBITDA that I've talked about, and you use that 6-time multiplier, look how each one of them is adding value to your business. And again, we don't normally look at it this way, but when you do, it's a compounding urgency on the importance of training, the importance of your pricing, your presentations of your maintaining your calls, hopefully growing them, and then certainly identifying and addressing proactively the discrepancies in average sale between one arranger and the next. And when you looked at that, both, my question to you, because it's probably a sobering answer some of you might have, is are both getting compensated the same and are either getting training, and one was adding $162,000 more value. And imagine that opportunity, if you will, in buying a firm and making those changes. And so there's a lot of, I always do this presentation in hand with our own businesses, because having these things handled in our own business not only increases the success for us in our own business, but helps us initiate these processes into other businesses we may buy that probably aren't on top of that, because they're in a mode of now wanting to sell, and so they're not doing these kind of things. So there's those are the opportunities that exist. So when you're buying an existing business, things to consider that I'd throw out there. Validate with tax returns. A comprehensive employee review is in order. It's the most expensive part of the financial statement, and you really need to have a good understanding of it. How long, how will this business run going forward? Is there enough staff? How about the benefit programs? Here's an important one. Will the acquisition make new competition come to town? That's one you can grapple with. I've seen in markets where, do you buy the competitor, or is it always going to be a two funeral home town? And can you own both funeral homes and not invite a third one? I can tell you that I've not seen it much, but I have successfully been involved in selling a business that the gentleman owned under two different names, both businesses in town, and it worked well. So it can be done, but there's I think you have to be careful with that. So, and then always the question, are they a good competitor, and is maybe good to just keep it that way? So, but the last one, and then sometimes everybody forgets that, we all forget to ask this question: what if they sell and we aren't the buyer and it's somebody else, and they come into town, and now you've got a real good competitor? So these are all the things that, as I would say, keep you up at night to figure out what's the right answer. But, there's the old saying, there's people that are making things happen, or wondering what's happened, don't know what's happening, or trying to make things happen. I can't remember how it goes, but you always want to make sure you're making things happen, even if it means at the end of the day you don't buy the business, that you were at least involved in the opportunity. I believe is important. So, and then remember, if you're buying a business, most of us are buying a business, and we have a business where we have very little debt or less debt, or we don't operate our business with debt pressures, if we're very lucky, and we're buying a business, and now we're going to throw all this debt, and it seems scary. Well, that's the part of it. That's the get busy living or get busy dying. And it seems risky because maybe the business is a mess, but was it supposed to be perfect? If it was, they probably wouldn't be selling. And so it's identifying what those risks are that create the opportunities for you, or show you that it's either a good or bad opportunity in itself. So, the owner is selling, they're tired and ready to get out, interest level is lower than in the beginning. So, identifying where those areas are for improvement and how you're going to address them in a good, systematic way, not to completely tear down that culture day one. I think implementing that strategy is very important. So, the reality check: people are interested in buying because they see opportunity. If that business has no opportunity, or your own business has no opportunity, that affects value. So, there's my comment. Consider that as a seller as well. So remember, some of the best deals you do are the ones that you don't do. And I get that from my father, who's bought and sold a lot of funeral homes. And it's true, that you can kind of look back on some that you really, you don't want to fall in love with the deal, if you will, but you certainly want to go down that road. You just want to make sure you're always keeping things in perspective, because you don't want it to be the downfall of everything that you've built up before you bought that business. So, doing your homework is important. So, know your own business first, and you'll be better prepared in acquiring another business. So, it goes without saying, and the books that I've read for growing your business. And I'm going to show you a book here that's a great one to read in this case. But you need the people, you need the strategies, you need the execution, and go figure, but you certainly need the cash to make it happen. And if you feel like any one of these things are lacking, I'm not saying you can't grow or you shouldn't be buying, but there are things that you should be working on to help you grow faster and do the things that you want to do, because life is short, and we're unfortunately on this planet only for such a period of time, and to execute on this when these opportunities come up, because they don't come up for us in the funeral business every day. You want to be prepared and you want to be ready. So that's one of the bigger pieces of advice I can give you. And I always love this quote by Albert Einstein, of all people. It's not that he was smart. He just said that he stayed with problems longer. So, if you see problems, don't give up on them, especially with acquisitions. Know that I've talked with deal guys that would say that sometimes a deal has to fall apart at least once for it to be a successful one. And I hope that doesn't happen to any of you as you go out and buy funeral homes. But the fact is, don't give up with it. It's check the ego, be a good intermediary, if you will. That's the reason that companies like mine exist. But there are people that are certainly successful in doing it themselves if you can put all these practices into place. And so, one of the books that I've read that's a great book for growing and scaling up. It's called Scaling Up, but Scaling Your Company. And it's written by Vern Harnish. He was the starter of the entrepreneur organization that I'm involved with. And, the book says how a few companies make it and why the rest don't. I would offer this to you to read. It'll help you in your quest for growth with your business, and taking all of the advice that I've just provided. So we're near the end here with the presentation, and what I'd like to do, I've got a Q&A window that you all may have available in your portal there for this webinar. If any of you have any questions you want to shoot to me, I'll pause for a second and read those questions. Otherwise, I'm always available to help as a member of Selected, and knowing possibly many of you that are on this call, and giving you any comments I have and helping you succeed and learn from the mistakes and the successes that my father and I have made as we've done this ourselves. I know one of the questions that I see or get is the value brands, the low cost market. I've seen companies out there that are specifically buying the value brand businesses, and because of the play for the rise in cremation. And the one thing to be careful of in the acquisition of these type of businesses is that, unlike our own business with the traditions and the heritage, all of those components that was in the value matrix that I mentioned, these businesses are specifically around based on their price in the market. And so the goodwill is less, and so the value of those businesses is accordingly. I assume all of us are contending with those type of businesses, and we have our own strategies and how we compete with them, either by starting our own brands. The good news is it's a little easier to start those brands and or buying them, but if we buy them, just to be careful, on the other matrix components that belong to a business like that. Another component that I would share with you with the acquisition of businesses is when you're buying multiple location businesses. We have a couple right now that I'm consulting with and helping that are businesses that are great funeral businesses. They're multiple locations, but there's a couple of the locations that are adding to the revenue that are the real estate far exceeds the revenue that's being conducted out of that building. And so then the question is, if you shut that building down and transfer that revenue, have you removed a defensive mechanism of your business ownership strategy, and somebody else may open? Or do you keep that business in there like that with that real estate value? And if you're approaching it right, most likely you're going to have to buy that location for its real estate value, not for the cash flow that it's producing. So there's some things to think about as it relates to buying businesses with multiple locations, especially when you get into rural towns and you have uh, locations that might have 60 calls and maybe 700,000 real estate value or something. There's some uniqueness to that. I think another question that I get is, and my father was very successful with this in California, in the Los Angeles market, and that's buying only the business and transferring it into your own facilities. And there's nothing more compounding in value. I showed it on a couple of my slides, in fact, in doing something like that. The trick is just how much do you pay for a business that now you have to transfer all that business and figure out how much you're going to get out of that, and how does that add value to your own firm, and how much do you need to pay for it if you don't get the real estate. And there's some tricks to that, and it really starts with, again, the financial review. It starts then the next column to that, and determining the pro forma is a safe percentage on how much of that business you think you will get, and and if ideally even of which case type you'll get, how much of the cremations will come over, how much of the burial business, all that kind of review. And then if you're not going to have a facility, you start carving those expenses out. You're going to usually end up with an EBITDA that's probably on the low side 40, on the high side 60% of revenue. And that's very high. You're not going to apply the same multiple to a business like that. Now it just depends on who your competition is to absorb such a business like that. If there's 100,000 in EBITDA, are you going to buy 2 years worth of it? Are you going to buy 3 years worth of it? Just how far do you want to go? You shouldn't pay more than 6 times, but there's no way you would do that, in my opinion, because you don't have to, quite honestly, unless there's other businesses in that market wanting to transfer that business. There's a risk associated with it, and chances are, with the real estate included, that business might have been worth, in that case, maybe that business was worth 500,000, and if you were to apply the same multiple without the real estate, you'd have a much higher value. So you'd have to be very careful just how much you pay for a business like that. But there's nothing more additive to your business than being able to absorb another business rather than acquire both the business and real estate, or even better yet, if you're ever able to do it, buying the business and the real estate, selling the real estate, pay for the business purchase price, and then absorb it into your own business. I've seen that happen. That's the best of all worlds, and you basically got the business for next to nothing. So, but understanding that real estate value is a key component as well. So that is my presentation for today. I hope you guys found this valuable and interesting, and that it helps you in your own endeavors. And my contact information again, Johnson at johnsonconsulting.com.